Well, here we go. Chapter 1. I will limit my lectures to only a few chapters for this particular course. But Chapter 1, again, is it's an introduction to finance. It's a little bit of accounting review, not much. But it goes over a lot of the terminology and those things that we will use throughout the semester, and kind of why I thought it was important maybe to lecture, if you want to call it that, a little bit. So got a PowerPoint, and as you'll note, the PowerPoint's posted. I've made, I think, one or two small changes to it, which I haven't updated. And then this is from last year again, which I'll replace with this particular video when I'm done. There's a lot of stuff going on right now in the economy and whatnot that makes this, I think, particularly interesting. And we'll talk about some of those things as we go along. So, Chapter 1, yep, the goals and activities of financial management. So, economics is huge when it comes to financial management, and just what's going on right now is a great indication of that, right? We went through a period, and most of you lived through a period of extremely low interest rates. Okay, my folks purchased a home. I won't say how long ago, but a long time ago, and they had a long-term fixed-rate mortgage that was pretty low, in the 3 or 4% range. Okay, when I started in banking. Again, I don't want to age myself a whole lot, but I think the very first loan I made was 21%. Okay, and at that time, home mortgages were 10, 11, 12%. Okay, then more recently, again, interest rates came down low. My wife and I were building a cabin, and we probably had the resources, we could have paid for it, but I called the bank, and we could get a loan for 2 3/8% interest, lowest in my lifetime. I'm getting kind of old. Again, these are decisions that I'm talking from a personal standpoint, but these are decisions that get made in the business finance arena as well. Is it good to take my resources, cash in some of those resources, which may have had tax implications, or maybe borrow the money, 2 3/8% interest? Wow, I've got stock in some companies that pay more than that as a dividend. Okay, so for me that became kind of a no-brainer, and again, those are some of the things that happen in business finance all the time, right? And so that's why economics is important. Why are we seeing inflation right now? Most people will say that it's because we had a lot of fiscal stimulus coming out of the COVID pandemic. Okay, not only did we have fiscal stimulus, we had monetary stimulus, which is the Federal Reserve Bank pumping up the money supply, or building up the supply of money in order to avoid a recession. Unfortunately, now to fix inflation, there's a good chance the Fed's cutting back on all that monetary stimulus, and we're probably going to see a recession, but maybe not. Accounting provides these things, right? Income statements, balance sheet statements, and cash flows, taxes, lots of other things that accountants do. I've often said that I hate accounting, but I love accountants, okay, because they're willing to do that tedious work that I don't like. Other people love it, and God bless them, but I like to read the results, and that's kind of what finance is about, is taking a look at those things, right? And we're in a really unique labor market right now. There are some big layoffs coming from big companies. Amazon announced 18,000 layoffs, and some other huge companies have announced some big layoffs and have done big layoffs. But at the same time, the unemployment rate just went down to 3.5%, and there are upwards of 10 million jobs open in the United States. And so it's a real unique situation right now, and maybe if we go through a recession, it may kind of equalize those things. So anyhow, the evolution of the field of finance in the 1900s, right, kind of emerged as a separate field from economics and accounting, probably. and folks started to look at it as how do you manage a company's money, let's say, right? Okay, And in the 30s, of course, the 30s was the Great Depression, right? We talked about capital preservation. What do we do to retain just the capital, the money that we have, right? Liquidity. And capital is assets, I should say. Okay. Liquidity is actual cash. Okay. And cash is king a lot of times, but cash can also, we don't want to have too much cash because we want to keep our funds invested. That's the only way we make money, right? And so liquidity maintenance is a huge issue, but where do you draw that line? Where do you make those decisions? And we'll talk about corporations that have all kinds of liquidity, but then corporations that have gotten in trouble because of liquidity crises. So reorganization of financially troubled corporations, what goes on then? We can talk about some of those, of course, in the bankruptcy processes. And I've been reading the last few days is Bed Bath & Beyond may be facing bankruptcy here shortly. But you probably didn't know this, but Northwestern Energy, which supplies most of our electricity and natural gas and those things in our area anyhow, went through bankruptcy several years ago, 10, 12, 15 years ago. But it was Chapter 11 bankruptcy. They emerged from that, and they've been a relatively strong company since. So in the 50s it becomes more analytical. What happened? Well, computers came around, calculators, those types of things. We were probably able to do a little bit more easily, with tools that were created, right? So we started worrying about cash and inventory management, and you saw big companies. Inventory management, just-in-time inventory, became a big deal, right? Capital structure, and what do we talk when we're talking about capital structure? We're talking about equity versus debt, okay? In your capital structure, and how much of each you want to carry, okay? You'll hear me often probably in this class say that debt's cheaper than equity, and it always is, okay? As interest rates are going up, that difference is maybe a smaller, but debt's typically cheaper than equity. But a company that has too much debt as a part of their capital is also going to be more risky, right? A lot more risky. And then dividend policy came up in the 50s, and one thing that's been added since then is maybe stock buybacks. You didn't talk maybe about that so much in the 50s, but that's something that's become huge, and I think I'll talk about that or show you a few things later. So some modern issues, right? Okay, focus on risk and return. Risk and return always go hand in hand. Okay, if you get that flyer in the mail that says, geez, we promise you a 20% return on your investment, that should bring up red flags all over the place. Okay, nobody can promise, I don't think, that type of a return, okay, without there being a whole lot of risk involved in it. I'm not saying run for the exits, but I'm saying really, really, really study that very, very carefully. Okay, and I'll talk about one that's going on there that just happened recently. But maximizing return for a given risk level. Now, we should accept some risk sometimes. Okay, it's important to accept some risk sometimes because we can really take advantage of that and get some greater return. And if you look at small cap stocks over time versus large cap stocks over time, small cap stocks tend to outperform, okay, over time large cap stocks, large capitalization stocks. They're riskier, okay? Individually, they're riskier. If you buy a portfolio of them over time, you're probably going to do a little bit better, okay? But you will take on a little more risk. So portfolio management, there we talk about sometimes the excess capital that companies have and what they do with that, their whole capital structure, those types of things, those kind of tied together. And we'll talk more about that again as the class goes on. Hedging. What's hedging? Well, in our area, hedging is actually fairly common. You look at agricultural products. So, a lot of farmers, a lot of my former customers, this time of year, probably more often in March and April, they would be looking to sell some of the crop that they plan to grow this year, right, in a futures market. So they might sell a contract. I think the contract was generally about 5,000 bushels. And they might sell a contract, okay, for fall delivery then, right? it would lock in a price. Okay. I don't know if that's technically considered the hedge, but what the hedge would be then, so they lock in that price. Maybe they're going to get $8 a bushel. That's maybe close to what the going rate is now. I'm not sure. Um, but what if they wake up the next day and they start, God, what if the price goes up? I don't want to miss out on that. Okay. We could go in the futures market. You could buy a call. Okay, a call option it's called. In the money or out of the money, gets a little bit more technical in it. I'm not that up on all those option markets, but you could buy a call option, which would allow you to buy grain, buy it back basically in a sense, okay, at a given price in the future. So you'd be hedging. So if the price went up, say, to $10 a bushel, well, you could buy your grain back maybe if you bought an in-the-money call, say at your $8, and then you'd realize that $2 gain. You'd obviously have a little bit of an expense in the option. So yeah, maybe a little more technical than what we need to be, but farmers ranchers have used hedges for years, probably decades now, and they use those same things in the marketplace, and companies do that, okay, all the time. Inflation, most of you grew up in an era of almost no inflation. Inflation was just modest, a couple percent, at the most, okay, during most of your whole lifetimes. And so it's now become a thing. We're talking about inflation over the last year that's been somewhere between 7 and 9%. I've told classes in the past when I went to college, inflation was horrendous, even probably worse than what we're seeing now. And at that time, we individually I worked in retail, and we individually priced items. And a good part of my job was going around and just changing the prices on items. We'd have to rip off old price tags and put on new ones. Of course, now they can just put the price on a little counter tag and then change it in the computer. So when it gets scanned, they can realize that price increase. But yeah, we're dealing with something that most of you have not seen in your lifetime, and that's created an interesting dynamic, and we'll talk about that as the semester goes on. So some modern issues in finance also can include factors in the decision making, right? The effect of inflation. We haven't seen deflation too much, and deflation can be a concern. Prices going down, right? Required rates of return. So if you're going to borrow money, or if you're going to sell stock, what kind of rates of return would you look at? And then cost of capital. Again, capital can be debt or equity. You'll hear me say often that debt's generally cheaper, almost always, or is always cheaper than equity. Oh boy, we saw that in the past year. I would say last fall it probably hit its height, didn't it? When they're talking about the recent financial crisis, and we're sort of kind of going through one right now with the inflation and whatnot, and the prospect of a recession. But in this case, they're talking about the one of 2007, 2008, maybe into 2009, which, again, most of you are either pretty young, when that happened, and probably have no recollection of it. For those of us a little older and lived through it, too, it's often been referred to as the Great Recession. So we had the Great Depression of the 30s, and maybe the Great Recession of the aughts, I guess you would call it. And we could spend a whole semester talking about what happened there. Credit default swaps, collateralized mortgage obligations, mortgage-backed securities. We won't get into that a whole lot, but it was a scary and frightening time economically and for finance people, right? Here they're talking about the credit default swaps and the unregulated financial products that existed outside. And banks were somewhat investing in those, and some of the banks collapsed, some of them failed, okay? And in your lifetime, you don't hear a lot about banks actually failing. They're backed by the full faith and credit of the U.S. government. That doesn't mean they can't fail. That just means that depositors' money are safeguarded. Okay, and boy, it was a frightening time. Okay, government intervened. There were bailouts of banks. Citibank, a big one, Bank of America. Okay, most of the big banks, large banks, had to take money from the government. The government took equity positions in those banks. I think they've all been paid out now, or they've those banks have paid off the government basically, or bought back that equity. And it also introduced a whole new set of financial regulations. And again, I could teach. I'm going to kind of go through this a little quickly because we could teach a whole semester, maybe a whole year on some of the things that went wrong. But part of the thing that happened was, banks are a highly regulated industry, and a typical bank functions as it takes in deposits and it lends that money then to borrowers, and the borrowers pay it back, and the money that it takes in as deposits insured by the federal government. Okay, that's the basic function of a bank. But part of what happened and what caused the crisis was banks were taking in deposits, and then instead of lending those out, to customers, they do their due diligence and ascertain whether the companies were, or whether the customer's worthy or not. They were taking that money and investing in some of those things that we previously discussed, the mortgage-backed securities, the credit default swaps, some of those things that were a lot riskier than just your car loan to Joe Blow down the street, okay? And those things collapsed, and that created a lot of problems. And so one of the things that they did, get down here kind of to the Volcker rule, was kind of went back actually to an older rule. It was almost like Glass-Steagall, I believe is the name of it, and said, let's keep those funds separate. So even though big banks oftentimes have separate departments for a lot of different things like trading and those things, so we're going to keep those funds separate. So if you're going to act in both cases, you can be a regular bank and you can take deposits and lend money, or you can be an investment bank, say over here, but you're going to keep those things separate, okay, so that we know what's going on, and it's going to be regulated by both the banking industry and, in that case, the SEC. Created again, the Consumer Financial Protection Act created another bureau, and geez, imagine that, another government entity. So, internet, right, has changed a lot of things, right? We got e-commerce going on now, and people ordering. Look at the point of sale now. Oftentimes you go in a place and you buy something, especially if it's a regularly carried item. It gets rung up at the counter, and guess what? As it's rung up, it's also placing an order for that item to be replaced. For the retailer. When I was in retail, orders were placed through the mail. Okay, you had to write up order tickets and do things like that, and just put them in an envelope and send them through the mail. Imagine how long that took compared to now. Weeks. Okay, and so as a result, way back then, retailers had to carry a whole lot more inventory than they do today. In most cases. So, of course, we got Amazon, eBay, new businesses, right? We got new financial companies that are coming in, that aren't banks. Banks always kind of controlled the payment system, it was called. You wrote checks, you had credit cards, those types of things. Just about all went through banks. But you're seeing other finance companies, PayPal, Venmo, things like that, Square, right, that have kind of replaced some of those traditional banks. I don't think it took off, but at one time Walmart was offering to basically pay their employees with like a Walmart credit card. And they might get bonus points if they spend it back at Walmart. Those types of things. A lot of them have come in and changed. Kind of that traditional finance system that we all grew up with and expect, and that's fine. Change is good, and the competition's good. But we've also had some things like cryptocurrencies. That's going to be interesting. I'm gonna break out here for a bit and talk a little bit about crypto, just briefly. In the news lately, right, there's a crypto firm called FTX. It was run by a guy named Sam Bankman-Fried, and if you followed that at all, you see that it, not only did it grow broke, it looks like there may be some nefarious activities that have taken place, and we can say that pretty with a lot of confidence, because a couple of the people have already pled guilty, right, to engaging in some nefarious activities. And so, FTX was an exchange only, right? So meaning that it was a place that you could go to purchase cryptocurrencies if you wanted, and supposedly they were going to hold those cryptocurrencies on account for you. Well, I think, and again, this is a real basic summary, but what would happen is people were sending money to FTX to buy the cryptocurrencies, and FTX was using the money for things other than buying the cryptocurrencies. They might have showed them that you had an account with those cryptocurrencies, and then, when the house of cards came tumbling down was when people started calling up FTX and saying, well, I want to exchange my cryptocurrencies back for dollars. Okay, and all of a sudden, guess what? FTX didn't have the dollars because they had invested those or used the money for some other, again, things that weren't quite legal. And you can see there are lots and lots of headlines on this, and we're seeing some other crypto exchanges that are having problems. Some other ones could collapse even though they may have been very legitimately run, right? It could take a few months for the fallout. He pleaded not guilty, and it's interesting if you haven't followed it or looked at it. It's really interesting. It turns out it was kind of a big Ponzi scheme, not unlike Bernie Madoff from a couple decades ago or 15, 20 years ago. Anyhow, interesting stuff if you want to kind of watch it. So, or go read about it. So what do we do now, right? Financial management. If you're in a company. Again, it's not unlike your personal situation. It's not unlike me telling you, geez, do I want to take money out of the market and use that to pay for our cabin, or do I want to borrow that money at rates that are extremely low? Rates aren't so low now. My decision today may be very different from what my decision was a couple of years ago, because rates, inflation, those types of things have changed a lot, okay? And that same types of conversations or same types of decisions have to be made in a business sense, right? So what do, right? Do you allocate funds to current or fixed assets? Geez, that decision gets, right now I'm kind of, my uncle's turned a lot of his investment stuff over to me to kind of handle, and I'm kind of, dealing with that. The market's been beat up a lot. The stock market has been beat up a lot. And on the other hand, bonds and CDs are paying not too bad compared to what they were paying several years ago. So do I want to put his money into stocks and bonds or stocks, or do I want to put him into bonds or CDs? And if I want to put him into bonds or CDs, for how long? Over time, the stock market's going to outperform bonds and CDs. Always has. Over time, but when do I make that transition? And so, those are, and same thing, again, business decisions get made that same way, right? The best mix of financing alternatives. So that's talking about if you're running your company, do you borrow the money or do you sell stock, which is an equity thing, right? And then develop an appropriate dividend policy within the context. Dividends are one thing, but this kind of goes unsaid in this particular slideshow, PowerPoint, but I want you to take a look at also this, right? Companies have more recently, they pay dividends still, and there's some companies that are really, really good dividend payers, but these are the authorizations of buybacks, okay? What's that mean? Well, a company buys back its own stock oftentimes. Okay, and right now, again, the market's really, it's been beat up a lot. And there's some particular companies that their stock is way down, Facebook being one now called Meta. But even Apple's taken some big hits, as has Amazon and Microsoft. Well, I'll speak in terms of Apple and Microsoft. I follow them a little bit more. They both have just tremendous amounts of cash. Okay, they've been cash cows for years, and even though both companies have through the years been buying back some of their stock, okay, they're probably doing even more of that right now. They're using up some of their cash and using that to buy back stock. What's that mean? Well, if they issued, really simplify it, but if they issued 100 shares of stock, they can go into the marketplace just like you or I and say, we want to buy 10 shares of that stock. And in a sense, it's kind of retired. It's put on the shelf. They could resell it at a later date. But they take that. Now, all of a sudden, there's just 90 shares okay, on out in the secondary market instead of the 100 shares. Well, what's that mean? It didn't change the net worth of the company, because the company spent cash to buy back those shares, and thus their equity would actually be the shareholders' equity would actually be reduced. But what it does is then, buying that back isn't going to change Apple's ability to generate profits or cash. And now all of a sudden those new profits are going to be spread out over fewer shareholders, or at least fewer shares outstanding. Okay, so those folks that still have those 90 shares should get a bigger profit per share in the future as it goes along. And that's important. And you'll see here, this shows, the amounts. I think this would be billions, right? So there's like 1.4 in 2022, over 1.4, or maybe 1.4 trillion, I'm guessing, is what that is, of dollar amount of stock that were bought back by companies. I'm pretty sure that'd be 1.4 trillion. That's a pretty big number. Okay, again, that benefits those people maybe that hang on to their stock. But if you're selling your stock, there's nothing wrong with that either. You can either sell it back to the company or to somebody else. So back to here. Yeah, here we go, right? Things that a financial manager does, right? Just basic day-to-day things. You're managing the credit of the company. When do you pay your bills? When do you send out your statements to receive for your accounts receivable? And controlling the inventory, receipt and disbursement of funds. Yep. But then you got to issue, or you got to talk about these things. Do you want to issue some stock, or if it's not in here, maybe buy back some stock? Would you like to issue a bond? Okay, those same companies had the same decision that I did. Microsoft and Apple, interestingly, a few years back, were still buying back stock at tremendous amounts of money. They were borrowing the money oftentimes to do that, even though they had huge cash reserves on hand. It was just strange, in some ways you'd look at it. But take a look at Microsoft, and you find out that their credit rating is better than the credit rating of the United States government. Microsoft is AAA, and the United States government is AA minus or something like that. They could borrow money literally over a fairly long term at like maybe 1.5% or 2% interest. Okay, they were hanging on to their cash. Why were they hanging on to their cash? Well, right now they're trying to buy a company called Activision Blizzard, or Blizzard Activision. It's a gaming company, I believe. It's $68 billion. Well, Microsoft's got enough cash on hand. They can probably write a check for that. Okay. Part of the reason they got the cash on hand is because they were borrowing money in the past to buy back these stocks. Again, now that interest rates are higher, they probably can't borrow money at 2%. They'd be more like 5%. That whole decision may change. They may decide to spend some of their cash on actually buying back stocks and using cash to buy Blizzard Activision, or Activision Blizzard, whatever the heck it is. Okay. Rate and risk always go together. Risk and return, I should say, always go together. Okay, capital versus labor. We're seeing this more and more. Companies are, labor's gotten really expensive and it's hard to find. So McDonald's puts kiosks in and puts out an app for cell phone users, smartphone users. You can do your own ordering now, whether you're at the kiosk in the place. And I've been to, I think, one McDonald's at least where that was your only choice. They didn't even have somebody at the counter. You had to place your order on the kiosk or on the phone app. Okay? More and more people are doing that. More and more businesses are doing that, right? And then the risk return, also the financial mix, stocks versus bonds, okay, versus keeping money on hand. So, again, that stock bond thing, and we're talking about big companies buying back their stock, oftentimes issuing bonds. That's how they borrow money, by the way, is that they issue bonds. Sometimes they go to the bank and they'll have financial institutions, but they're talking about huge dollars, but two, they can get rid of the middleman. They don't necessarily need a bank. They can just say, go to an investment banker and say, we're going to raise $100 billion in cash, and we're going to issue bonds, probably varying maturities. Boom, put it out. And for those companies that are highly rated, pretty low cost of borrowing that way. Different forms of organization. I'm going to go through this really quickly. You guys have probably had that in business law or some of your other business classes. Sole proprietorship, right? You take on all the liability, but you pay all the taxes. Partnership's very similar, other than you got maybe a couple people, but also unlimited liability. You can have limited partnerships. You can also have limited liability partnerships, okay? And that's where you might have a partner that's a silent partner, sometimes we call them, or maybe they're going to invest some money, but their liability can be limited. They might lose their initial investment, but they won't be sued for other problems that the company may have had or caused. Corporations, then again, is a separate entity unto itself, and virtually all the big companies that we see are corporations. There are some exceptions to that. Twitter, right, went from, and it's probably still a corporation, don't get me wrong, but it went from being a publicly traded corporation to now privately owned corporation, so a little bit different, right? Form through articles, you can issue as many shares. You got to get approval, but basically you can issue as many shares as you want to. And the shareholders, again, enjoy limited liability. And we call it limited because, again, their investment in that company is subject to risk, okay? But they won't be sued then for things that the company has done, okay? And it can have continual life, right? Disadvantages, double taxation. What's that mean? Well, corporations all pay taxes, okay? They're subject to U.S. income taxes, and most states have corporate income taxes as well. But the double taxation can occur then when they pay a dividend, right? If they pay a dividend, then you as a shareholder are going to pay taxes on that dividend as well. So technically that profit that the company earned has been taxed twice, and so we call it double taxation. S corporations are a little bit different. There's some rules on how big they can be, how many shareholders they can have, but it's said to be a pass-through entity, meaning that the profits or losses flow through to the shareholders in that case, and so it's not double taxed. Okay? So they you fill out a return for the S corporation, but if the S corporation makes $100,000 and there's two stockholders and have equal amounts, then each shareholder has to claim $50,000 on their own personal income tax return, not as a corporate tax return. Okay, LLCs are kind of a hybrid. Some of the best things. Typically, they're going to be taxed like a partnership or a sole proprietorship, and it only takes one person. But you can elect to be taxed as a corporation. You know, why do you do that when there's double taxation? There's reasons. Accountants will tell you that there can be good reasons to have a corporation. For one thing, corporate income taxes are generally less than personal income taxes. So if you've got a corporation and you're going to retain a lot of the income in there, over time, you might be able to benefit by having a corporation versus, an LLC or an S corporation. Agency theory, right, examines the relationship between owners and managers. When you have corporations, right, you got a board of directors, they hire managers, but then you got shareholders, and they get to vote on the board of directors basically, and sometimes some other shareholder proposals. Institutional investors, they're kind of, what's an institutional investor? Let's take a look. Here we go. Institutional investor, company or organization that invests money on behalf of other people. So what do we have? Mutual funds, pensions, and insurance companies are good examples. A lot of state funds, right? And state funds are generally the pension funds of people that work for the state government, right? And they pay into this pension fund. There's huge balances for some of these states, multi-billions of dollars, okay? And the state invests those with companies. Sometimes some states set up their own investment companies, basically, okay? And they invest that on behalf of the pensioners, right? Mutual funds and ETFs are very similar, some subtle differences, but that's if you're not really interested in researching and studying a lot of individual stocks, you're probably better off putting your money into a mutual fund. Let somebody else do those types of decisions, and it also gives you a lot of diversification because a mutual fund or an ETF will own hundreds maybe of companies. So if one of those companies fails, the impact on your investment is tiny, maybe even almost unnoticeable. right? Because the other 199 companies are still doing just fine and are making enough money to offset the loss from that one company. Okay, so mutual funds are a great investment tool. We'll talk a lot more about those probably again as the class goes on. Sarbanes-Oxley was set up after the Enron debacle, and again, that gets to be kind of a long thing. I don't think I'm going to spend a lot of time talking about that. Goals, right? Is the goal still maximization of profit? I'm going to tell you that in the news today, you're going to hear a lot about the goals of corporations shouldn't be just to maximize profits. They ought to also do some other things that are socially responsible, et cetera, et cetera. Lots of arguments going on about that, and we'll talk about it, a little bit of that, a little more of that here in a bit, right? Broader goal, maximizing shareholder wealth over time. Okay, there's different ways to maximize their wealth. Again, you can pay dividends, you can buy back stock, but you can reinvest in the company and grow, right? For a lot of years, Amazon did not show a profit. And Amazon's a huge corporation, and even then it was a huge corporation, but they were investing all their income, if you want to call it that. They were investing it back into the company, so it became an expense, and they just didn't show any income, and they certainly didn't pay any dividend. I don't know if they even pay a dividend yet today, because they still invest a lot of money back into the company to grow that company, right? And over time, if you were an early investor in Amazon, over time that really paid off just because the value of your stock, your individual stock, is a lot more than it was to begin with. Stock options are a way to motivate employees. Okay, a lot of companies have gotten away from stock options, instead do stock gifts, basically it's called. Stock options create some accounting things. I do think we talk about those a little later, and so I'm not going to go into it at length there. Right? Ultimate measure of performance is how earnings are valued by the investor. Some investors prefer dividends, and why is that? Well, a lot of them maybe are retirees and they want that income to live off of. Other investors, like those maybe of your age, you might be more interested in growth. You don't really want dividends, and if you're at the height of your earnings, as you're working, you're earning a lot of money, you don't want the companies to pay you dividends, and you got to pay more taxes and at a higher rate, at a higher bracket. You just assume they, like Amazon, just keep investing that money back in the company and growing it if they can. Okay, some companies reach a time sometimes when they have a difficult time growing, and that's when they do start paying dividends or buying back a lot of their stock. And so, choosing the right investments, they're again personally, or if you're managing the funds of a company, choosing those right investments are extremely important, right? Or if you're that company that's paying out those things, if you want to pay out dividends, you want to buy back stock, what do you want to do with those excess funds that you might have? And which ones are going to increase your shareholders' value, right? Here's social responsibility and ethical behavior. Again, this is becoming a big deal, but we're seeing some pushback too. Insider trading, we can talk about all kinds of stories. We go back to Martha Stewart's probably the biggest one, but here's this is the current word or mnemonic or whatever you want to call it for what's going on. It's called ESG, environmental social governance. Some sites you go to and you look up a company, and that might be one of the first things that show up is their ESG score. That's that they're looking at a company and saying, boy, this is really important, or maybe this, being a green energy company, or not, having a bunch of electrical vehicles in your fleet. Those types of things give you good ESG score, right? But they're seeing some pushback. And let me kind of, another state constitutional officer calls out the ESG. Republicans want BlackRock and went after, right? BlackRock and sustainable investing. What's going on? There's been probably a dozen state investment folks, chief investment officers that have told, like Vanguard and some of these, and BlackRock, some of these other companies, that they're not going to invest with them if ESG is a focus. they're investing to make money for their pensioners, and that's what they want the companies to focus on, is making money. Okay, not so much the ESG. Companies should follow the laws, don't get me wrong. If there's environmental laws, companies need to follow those. But companies' first priority needs to be making money, not worrying about how many green cars that they have running around. Those types of things are, less important. Now, there's a lot of states that take the opposite approach, and they insist that the companies that they invest with have high ESG scores. And so you've got this dichotomy, these two different approaches in looking at those things. And again, for somebody that's lived this and taught it, it's very interesting to me. I hope at some point, you read about it and it becomes as interesting to you, right? So yeah, financial markets, right? And again, public financial markets are going to be, we're talking about U.S. government borrows a lot of money, right? And so that's part of the public financial market. But then corporate financial markets are the stocks and bonds that corporations issue in order to raise money and fund their activities. I got a lot of domestic and international markets. You and I can buy bonds in, Bunds, I think they're called, for Germany, or, England. Probably even buy some for Russia and China if you were so inclined, and found a broker that would do that for you, right? There's a lot of that goes on. Foreigners own a lot of the U.S. debt, I don't think we could borrow the $31 trillion that we have outstanding if foreigners didn't own a lot of that debt. Money markets are short-term. I'm going to go through this kind of quickly again. Money markets are short-term, meaning that it's paper borrowings that are less than a year. They have maturities of less than a year. And capital markets are the opposite. That's anything over a year. Okay, it also includes common stock, preferred stock, those types of things. Now, common stock's considered in the capital market, even though you could buy and sell that. You could buy it today and sell it in a month. Okay, but it's still considered a long-term security, because even if you sell it, it still exists out there, and it will for a long time, right? Primary market is when a company issues stock to begin with, new stock, right? Often, if it's done for a startup company, it's called an IPO, or an initial public offering. Okay, and that's sold in the primary market, meaning that it's going to hit the market. You and I can buy it. Okay. After some things with investment banking, and we go through that a little bit later. But you and I can buy that stock, right? But most of what we see on a day-to-day basis is the secondary market, where stocks are bought and sold. So if I called my broker up and said, I'd like to buy some Apple stock, I'd be buying it from some individual someplace, who knows where, or maybe an institutional investor someplace that wants to sell it for that same price. I'd call my broker and say, I'd like to buy 10 shares of Apple stock for $130 a share. And if there's somebody out there, he kind of posts that, basically. If there's somebody out there that's willing to sell 10 shares for $130 a share, then the transaction takes place. Okay, but that's in the secondary market, right? I'm not buying it from the company in that case. In the primary market, you're technically buying it from the company itself. Maybe an oversimplification, but again, risk and return, kind of, yeah. Companies, when their stock prices are down like they are right now, that's oftentimes when they like to buy back that stock. But maybe if their stock prices are real high, sometimes they do like to issue stock, okay, and raise capital, because maybe they're overvalued at that time. Okay, yeah, firms definitely pay a penalty for failing to perform. They have to submit their earnings to the SEC, submit financial statements to the SEC each and every quarter, and you and I get to look at those, and that puts a lot of pressure on companies to perform. We're seeing restructuring companies, and that's part of what's going on right now with some of the layoffs that we're seeing with some of these bigger companies. They're restructuring. They're trying to find ways to make more money, and so they're laying some people off. Twitter just went through that when Elon took over, right? He went in and fired a whole bunch of people, and he's restructuring the company, trying to find different ways for it to make money. It includes mergers and acquisitions, and again, Twitter's a pretty good example of that and what's going on there. So internationalization, we've kind of talked about, right? I want to get, technology is just amazing, right? Major stock exchanges have Imagine in the old days, if you watch some old shows, there's just kind of an old funny one called with Dan Aykroyd and Eddie Murphy. It's called Trading Places, and they actually show people that's in a commodities market, but they show them down on the floor, and buying and selling. In this case, commodities, probably futures, options, those types of things. Okay, that's how the stock market used to be. Okay, some of the commodity markets still operate that way a little bit, and so that was before the age of computers, really, and it took place. If you want to watch, it's a good, funny movie, and it was interesting. I mean, when I was younger, you could tune that in the news sometimes and see those folks down there hollering and screaming, and they were buying and selling, and that's how they actually did it. And it was actually, for its time, it was fairly efficient. But now, of course, that's all computerized. When I call my buddy the broker and say I want to buy that 10 shares of Apple, he plugs it into his computer, right? And then it gets exposed to people all over the world, maybe through either the NASDAQ or the New York Stock Exchange, probably one of those two. And if somebody out there wants to match that bid or wants to sell me that stock, then it happens, right? Okay. Traditional organized exchanges such as the New York Stock Exchange, but it's gone computerized too. It's gone electronic. Okay, so they're all electronic now. And it's amazing how quickly those things can happen. Literally, sometimes I do call my broker and I say, I want to buy, 20 shares of this for this price, and he plugs it into his computer. And while we're still on the phone, he can tell me, oh, well, your trade got confirmed. It happened. Okay, it's got posted. It happened within seconds. It can be that quick sometimes. So pretty amazing. I have gone on long enough here, 45 minutes. Yeah, that's about a normal class period, but longer than you probably wanted to listen to me. Hopefully you broke this up. But again, a lot of terminology and stuff that we're going to be using throughout this semester. Thanks for listening. Have a great day.